dream of owning property in Australia. And it's still a big one, isn't it? Right behind it, often, is that ambition to become a property investor.
Yeah, definitely.
But then, the doubts creep in. How could I possibly find a deposit? This all seems way too complicated. Or even, maybe I'm just too young for this right now.
Those are really common thoughts.
So today we're doing a deep dive. Is Australian property investment in, say, 2025 really out of reach? And maybe more importantly, are there practical ways in that might, well, surprise you?
Exactly. And we've pulled together some really useful sources for you. We've got stuff from realestate.com.au, Carbon Group, Berry Plant, Westpac, Aptium Financial, Duo Tax, We Connect Property.
And even a pretty candid Reddit discussion thread. Lots to draw on.
Yeah, a good mix. Our goal here is to kind of sift through all that, look at the realities, the potential, in the current landscape.
Right. The mission is simple, really. Cut through the noise, find some actionable insights for investing in Australian property as we head towards 2025. Let's tackle those common worries and maybe shine a light on some paths you haven't thought about.
Sounds good.
Okay, first things first. That huge barrier for so many people, the initial funds, the deposit.
It really is. Hubbard from Invest by Metricon points this out. Affordability is, well, it's a big concern for people looking to invest.
Understandably.
But what's quite interesting is this idea he brings up, dormant equity.
Dormant equity.
Yeah, so a lot of homeowners might not actually realize how much the value of their own home has gone up.
Ah, yeah.
And that equity, the value built up, could potentially be used as the deposit for an investment property. You might not need years and years of extra saving.
How much are we talking, potentially?
Well, look, it really depends on the market and where your property is, but you could realistically be looking at tens, maybe even hundreds of thousands of dollars sitting there.
Wow. Dormant equity.
Yeah.
It's like finding hidden money in your own house.
Kind of, yeah. And Hubbard's advice, crucially, isn't to just guess. No, he strongly suggests talking to a financial expert, someone who can help you actually figure out how much equity you have and if you can leverage it to, kickstart that investment journey.
Right. That makes it sound much more immediate, maybe, than people might think.
It can be. Definitely worth investigating.
Okay. Now, another thing we hear all the time is worry about timing, trying to pick the perfect moment to buy.
Oh, yeah, the crystal ball gazing. Hubbard has a good perspective on this, too. He argues that historically, how long you're in the market, time in the market, tends to be more important than trying to nail the exact perfect entry point.
So don't stress too much about the timing.
Well, the market goes up and down, right?
Right.
It fluctuates, but the longer you hold an asset, generally, the more chance it has to grow in value, riding out those cycles.
And he actually shared a story, didn't he? About a young investor.
He did, yeah. A 23-year-old who just became one of their youngest investors, which really highlights the upside of starting early if you can.
What are those benefits, historically speaking?
Well, more time for capital growth, obviously, the power of compounding, maybe from rental income, and just a longer runway to potentially build up a decent portfolio over time.
It's a big contrast, he says, to people he talks to in their late 40s, early 50s.
Yeah, who often say, gosh, I wish I'd started sooner. That regret factor. So, if the goal is long-term wealth creation, getting started earlier, even if it's a smaller first step, can put you in a much stronger position down the track.
Okay. So let's shift focus a bit. What kind of properties are people actually investing in? Are there trends there?
Yeah, it seems so. While, older established properties have always been popular.
Just the traditional choice.
Right. But our sources suggest there's a growing interest in new builds, especially for first-time investors.
Oh, interesting. Why is that?
Hubbard from Metricon again points to a couple of things. One big one is the tax benefits that often come with brand new homes. Depreciation, mainly.
Depreciation. We'll come back to that later, I'm sure.
We will. But also, new builds generally need less maintenance, at least in the first few years. That means fewer unexpected costs popping up right away.
Lower out-of-pocket expenses.
Yeah.
That sounds appealing.
Exactly. And often they're in these master planned estates, which can mean good rental demand. So it's a different way that seems to be gaining traction.
And it's not just about new versus old, right? The sources mention different strategies, too.
Absolutely. The Berry Plant Guide, for example, talks about that foundational strategy. Buy your own home first.
Your principal place of residence.
Right. Now, that doesn't give you rental income straight away, obviously, but it lets you build capital. And critically, when you eventually sell your main home, the profit is usually free from capital gains tax.
Which frees up that money for future investments. A springboard, you called it.
Exactly, a
Yeah.
solid base. Then you've got the classic buy and hold strategy.
Just sit on it and wait for growth.
Pretty much.
Yeah.
Long-term capital growth is the main goal, maybe with some rental income along the way. And then there's subdivision. That sounds a bit more involved.
Yeah, that's definitely more strategic.
Yeah.
Buying a bigger block, dividing it up, creates different options. Maybe sell off some land, build on the rest. Higher risk perhaps, but potentially higher reward for the right person. A good bit of planning and maybe deeper pockets.
For sure. Longer-term vision required there.
Okay, we've covered getting started, different property types, different strategies. Let's tackle something that sounds a bit technical. Gearing. What's that all about?
Yeah, gearing. Simply put, it just means borrowing money to invest. So using a loan to buy that investment property.
And there are different types.
There are essentially 3 ways it can play out: positive, neutral, or negative gearing. Neutral just means the rent coming in basically covers your costs. But negative and positive have quite different implications, especially for tax.
Okay, let's start with negative gearing. That's the one you hear about a lot in off-lending. How does that actually work?
Right. So negative gearing happens when your costs for owning the property, think mortgage interest, council rates, insurance, maintenance, are more than the income you get from it, usually the rent.
So you're technically making a loss on paper each year?
Exactly. The property is running at a loss. But, and this is the key part in Australia, the tax rules let you deduct that loss from your other taxable income, like your salary.
So it reduces your overall tax bill.
Correct. This makes it attractive for investors who are mainly focused on long-term capital growth. They're willing to wear a small loss each year, offset by the tax break, hoping the property's value goes up significantly over time.
So while you wait for that growth, the tax deduction helps soften the blow.
Got it.
And positive gearing.
That's the flip side. Positive gearing is when the rent you receive is more than all your costs, including the mortgage payments.
So the property is actually putting cash in your pocket each week or month.
Yes, it generates a positive cash flow. That's obviously appealing for investors who want immediate income from their investment.
So choosing between negative and positive gearing really boils down to your own financial goals, doesn't it? And maybe your risk appetite.
Absolutely. What are you trying to achieve? Immediate income or long-term growth? Now, Daniel Hubbard also flags something else really important, something people often forget.
What's that?
The costs beyond the purchase price.
Yes. It's not just the price tag on the listing.
Not at all. It's easy to just focus on that number, but you've got to factor in a whole bunch of other things. Hubbard lists, stamp duty.
Which could be huge. Yeah.
Legal fees, conveyancing costs, insurance, property management fees if you use an agent, ongoing maintenance, repairs. It all adds up.
These aren't trivial amounts either.
No, they can be quite significant. His point is you absolutely need to do a proper cost analysis before you buy. Get a realistic picture of your total financial commitment, your actual out-of-pocket contribution, not just the mortgage repayment.
Makes sense. Know what you're truly getting into. Okay, we can't talk property without the mantra, location, location, location.
Yeah.
Still true for investments.
Oh, 100%. That old rule definitely applies. Hubbard mentioned that his group, Invest by Metricon, spends a lot of time and resources researching specific growth corridors.
They have a system for it.
Yeah, a methodology to pinpoint these areas they think have strong potential, and also identifying the key developers working there.
And did our sources flag any specific areas for, say, 2025?
They did. 2 came up prominently. One was Western Sydney.
Driven by the new airport.
Largely, yes. The airport development plus growing demand for logistics, business hubs, particularly around the M7 motorway area.
Okay. And the other one?
Brisbane.
The Olympics effect.
Seems like it. There's a definite surge happening there with forecasts suggesting pretty hefty price increases leading up to the 2032 games. All the infrastructure work, population growth, it's creating momentum.
Fascinating how those big projects ripple through the property market. Okay, changing tack slightly. Sustainability. Is that becoming a factor for investors?
Increasingly so. It's moving beyond just being, the right thing to do. It's actually becoming a smart investment strategy.
How so?
Well, the sources point out that green buildings can offer really significant savings on running costs.
Like energy bills.
Exactly. Energy efficiency measures can cut consumption by, get this, 30 to 50% compared to standard buildings.
Wow, that's substantial.
And water, too. Things like smart irrigation, rainwater harvesting, they can cut water use by up to 40%.
And do those savings translate into higher value?
That's the connection being made, yes. Properties with strong sustainability features are increasingly seen as more valuable overall. Good for the planet and potentially good for your bottom line through lower running costs and higher resale value.
Interesting. So green is becoming part of the financial calculation. Now, given how dynamic the market can be, especially looking towards 2025, risk management must be pretty crucial.
Oh, absolutely essential. You can't just set and forget. Diversification is a big one.
Spreading your bets.
Basically, yeah. Investing in different types of property or in different locations, it just means you're less exposed if one particular market segment takes a hit.
Makes sense. Oh, no.
Regular portfolio reviews,
Yeah.
checking in to make sure your investments still align with your goals and your risk tolerance hasn't changed. Also, being conservative with borrowing, not over-leveraging yourself, and having some cash reserves tucked away.
For rainy days.
Exactly. That buffer is critical if things don't go exactly to plan, like unexpected vacancies or urgent repairs.
Okay, good practical advice there. Right, let's get into something that really excites potential investors. Tax benefits. Australia seems quite generous here.
It certainly offers some significant advantages for property investors. We've touched on negative gearing.
Right, deducting losses.
Yes. But there's more. Depreciation is a big one.
Explain that again.
Okay, so you can claim a deduction for the decline in value over time of the actual building structure that's called capital works. Think walls, roof, floors, and also for the fittings and fixtures inside plant and equipment. Things like ovens, air conditioners, carpets, blinds.
And how do you figure out those deductions?
That's where a quantity surveyor comes in. They prepare a detailed depreciation schedule, which you then use for your tax return. It's highly recommended to get one done to maximize those claims.
Okay, what else? Interest on the loan.
Generally, yes. The interest you pay on the loan you took out to buy the investment property is usually tax deductible. That includes interest on loans for renovations or repairs, too.
Good to know. And just general running costs.
Yep. A whole range of rental property expenses can usually be claimed. Things like council rates, water charges sometimes, insurance premiums, property management fees, repairs, and maintenance.
Repairs and maintenance. Is
Okay.
there a difference?
Yeah, for tax purposes. Maintenance is generally keeping things in good working order deductible immediately. Significant improvements or renovations are often capital expenses, meaning you claim their cost over several years through depreciation rather than all at once.
Ah, okay. So record keeping must be vital.
Absolutely meticulous. Keep records of everything. Advertising for tenants, pest control.
Oh,
It can all add up.
right. And then when you eventually sell, capital gains tax.
Yes, CGT applies. But there's a potential discount. If you've owned the investment property for more than 12 months,
Yes.
you typically get a 50% discount on the capital gain. So you only pay tax on half the profit. That can make a huge difference.
50% discount. Okay. Anything else on the tax front?
One more thing is prepaid expenses. If you pay for certain things in advance, like maybe your insurance premium for the next year or some loan interest,
Yeah.
you might be able to claim that deduction in the current financial year, even though the expense covers the next year. Can be handy for managing cash flow and your tax position.
Wow. Okay. It really sounds like getting your head around these tax rules is absolutely fundamental if you want to make a success of property investment in Australia.
It really is. It can significantly impact your overall return. Consulting with a good accountant who specializes in property is usually money well spent.
No doubt. Okay, let's shift gears now. We've talked a lot about the mechanics, the strategies, the finances, but what about the actual experience? That Reddit discussion gave us some real human insights, didn't it?
It really did. Very frank, often quite raw perspectives from people actually doing it. What stood out to you?
Well, first off, it's clear it's not always smooth sailing. Not by a long shot.
Definitely not passive income in the way people sometimes imagine it.
Exactly. The importance of good property managers came up again and again, and good tenants, obviously. That relationship seems crucial.
Huge difference between a good tenant and a bad one.
Absolutely. And people shared such a mix of outcomes. Some talked about fantastic capital growth over many years.
Making serious money?
Yeah. But then others really felt the pinch from rising interest rates recently. And those ongoing costs, insurance hikes, body corporate fees, always going up.
Body corporate fees, just for listeners, those are the levies you pay in apartments or townhouses for maintaining the common areas, lifts, pools, that sort of thing.
Right. And they can be quite substantial.
They can indeed. And there was that whole debate, too, about managing it yourself versus paying an agent.
Yeah. DIY saves you the management fee.
But costs you time. A lot of time, potentially. Plus, you need to know the tenancy laws, handle disputes. It carries risk.
And that feeling some people expressed with negative gearing. like they were subsidizing their tenants. That was interesting. Balancing that short-term cash flow pain against the hope of long-term gain.
It's a mental hurdle for some, definitely.
Look, there were stories at both extremes, weren't there? There was that couple who apparently became millionaires through very strategic investing over decades.
An inspiring story, though probably harder to replicate today's market.
True. But then you also had people sharing nightmares. Problem tenants trashing the place, massive unexpected repair bills, people having to sell at a loss because circumstances changed.
Yeah, it really hammered home that it's not a guaranteed win. There's real potential, but real risk too.
The long-term nature kept coming up. Delayed gratification. Some people found it rewarding over time, but others just described it as like a constant headache and a drain on their finances now.
Yeah, and some even questioned if the returns were worth the hassle compared to, say, just investing in index funds or ETFs. Less work, maybe similar or even better returns for some.
It's a fair point. A really valuable dose of reality, I thought. Individual experiences can be so different.
Depends on the property, the market, the management, your own finances, luck. So many variables.
Okay, so bearing all that in mind, in a competitive market, like we might see in 2025, how do you actually find a property that represents good value? How do you spot an opportunity?
The million-dollar question. It starts with understanding the market dynamics. Is it a buyer's market or a seller's market right now? That affects your bargaining power.
Okay. Then what signs should you look for?
Well, keep an eye out for properties that have been listed for longer than average for that area. Why hasn't it sold? Is there an opportunity there?
Could be overpriced, or maybe something else.
Exactly. Also, properties that clearly need work, the classic fixer-upper, but you have to be really careful estimating those renovation costs. They can blow out easily.
Seen that happen.
Yeah. And look for motivated sellers, people who need to sell quickly for whatever reason, deceased estate, divorce, relocation. They might be more willing to negotiate on price.
So research is key again.
Absolutely critical. Dig into the property's history, how long on market, any price drops, but also research the wider area. What's planned? New infrastructure, council rates, school zones, even crime rates. It all feeds into value.
And when you make an offer,
don't just pluck a number out of the air. Make a reasonable offer, but maybe slightly lower, and be ready to justify why based on your research. Show you've done your homework. Be prepared for counteroffers. Be willing to negotiate.
And local agents can help here.
A good local agent can be invaluable. They know the area inside out, they know recent sales prices, and sometimes they know about properties before they even hit the market. Building that relationship can pay off.
So it's really about being diligent, strategic, and maybe getting some local expertise on your side. Okay, we've covered a lot of ground focusing on the potential and the strategies, but we do need to properly acknowledge the risks involved with investing directly in property.
Yes, absolutely crucial. We've touched on some, but let's recap. One big one is lack of diversification.
All your money tied up in one or maybe two assets.
Exactly. If that specific market turns down, you're fully exposed. Unlike shares where you can easily hold a diverse portfolio. Property is also illiquid.
Meaning hard to sell quickly if you need cash.
Precisely. You can't just sell a bedroom if you need $50,000. Selling a whole property takes time, involves costs, and you might not get the price you want when you need it.
And the tenant issues we heard about on Reddit.
Yep. Vacancy periods with no rent coming in, tenants damaging the property, tenants not paying rent on time. These are real risks that impact your bottom line.
Plus all those ongoing costs we listed before. Rates, insurance, interest, maintenance, agent fees. They keep coming, whether you have a tenant or not.
They do, and uncertainty around the sale date and price is another risk. It's just not as predictable as some other investments. You need to think carefully about how much of your total wealth you're comfortable having tied up in direct property, given these factors.
Right. It impacts your overall asset allocation.
Definitely. And just to round that off, remember there's a whole ecosystem of professionals who can help navigate this stuff.
Who are we talking about?
Well, valuers, quantity surveyors for depreciation, real estate agents, buyer's agents if you want someone to find a property for you, building inspectors, conveyancers, or solicitors for the legal side.
Property investment advisors, property managers.
Builders if you're developing, market researchers. Lots of expertise available. You don't have to do it all alone.
That's a good point. Okay, so let's try and wrap this up. As we bring this deep dive to a close, what's the main takeaway? Property investment in Australia for 2025. Doable. Complex.
I'd say it presents a real mix. There are definitely pathways, opportunities, potential rewards. but it's absolutely not a get-rich-quick scheme or something to enter into lightly.
It needs serious thought and planning.
Thorough planning, solid research, and a really clear understanding of both the potential upside and, just as importantly, the risks and costs involved.
And those initial barriers, like finding the deposit, maybe aren't as insurmountable as people think. Strategies like using that dormant equity could be a game changer for some.
Potentially, yes. Exploring those options is key. And remembering, it's usually a long-term game. Your strategy needs to fit your personal goals and your time frame.
And the tax side. Huge potential benefits, but you really need to understand them or get advice.
Absolutely. Professional advice there is often essential to really make the most of it. And hearing those real-world stories just highlights the complexities, you know. Success isn't guaranteed. Experiences vary wildly.
So it seems the dream is achievable, but it demands a clear head, ongoing learning, and being ready for, well, pretty much anything the market throws at you.
That sums it up pretty well. Grounded perspective, commitment, adaptability.
Okay, so a final thought for you, our listener, to ponder. Considering all these diverse strategies, the market shifts, the personal stories, what specific aspect of Australian property investment really warrants your deeper exploration as you think about your own financial future?
Good question to leave people with.
That's your food for thought from this week's Deep Dive.